G'day guys, welcome back to the Devon Too Good Investing channel. In this video, we're going to have a look at Alibaba's Q2 earnings. I know we're in Q3, but Alibaba do their reporting strangely. So we're going to have a look at their Q2 earnings. And you can see when these earnings dropped, they dropped pretty much on the 18th of November. And yeah, we saw the stock fall around about 11% that day, all the way back down to 140. So we're going to be sort of retesting those lows we saw, a few months back. We got back down to, 139, back in the first week of October, and now we're sort of testing those levels again. We're at a $381 billion market cap at the moment, and we're trading at below a 20 PE, which is pretty crazy for Alibaba. That's the cheapest it's been, pretty much since it IPO'd about a decade ago. So if we jump to the first page of Alibaba's earnings presentation, we can see there's a bunch of key numbers just listed on this first slide. We can see that revenue's grown 29% year over year. In particular, China commerce has grown 30%. The international commerce section of their business grew 34%, and their cloud computing revenue also grew at 33%. And straight off the bat, I look at these numbers and I think to myself, they look like they're starting to slow down. Everything except cloud computing, I believe, decreased compared to last quarter. So it seems like while I actually listened to the Alibaba conference call, and the CEO explained that the reasons why the revenue is sort of slowing down in growth compared to sort of previous quarters is due to the macroeconomic conditions in China. We can see that sort of spending conditions in China are starting to deteriorate slightly, and also due to increased competition. But if we have a look at their annual active consumers, they're at 953 million in China. And quarter over quarter, which is pretty crazy, they've added 41 million, which is quite impressive. In the conference call, they did mention that they will be at a billion AACs within the fiscal year, so within 6 months of now. In terms of the international AACs, we can see that it's at 285 million, and they've added 20 mil quarter over quarter, which is even more impressive growth, to be honest. And that's mainly driven through Lazada and Trendyol. On the conference call, I mentioned AliExpress is starting to slow down in terms of growth. But the main ones, Lazada and Trendyol, they perform strongly, and we'll get into how well they performed very soon. We can see adjusted EBITDA has actually fallen 32% year over year. However, they explained in the call this is due to greater investment into business initiatives to try to drive future growth. So pretty much it's just like a increase in sort of like capital expenditures. Hopefully that will reflect in their growth rates in the future. They did warn this was going to happen, so it's not a great surprise. And we can see their key strategic investments in commerce. It's up 12 billion RMB year over year. So their investment has like really increased. So they're really plowing a lot of their sort of profits back into their own business to try to keep that growth rate up. So if we have a look at their total revenue breakdown now, we can see that it's split out into commerce category, and then we've got the cloud computing category, the digital media and entertainment category, and then innovation initiatives in its own category. And if we focus on the total commerce category, we can see that e-commerce makes up 85% of Alibaba's revenue, and it's by far the largest sort of section in the business. And that will, at least that grew 31%. The growth is starting to slow down, but for a company as large as Alibaba, like 31% revenue growth is quite impressive. And if you exclude Sun Art, it's still around 16%. That is on the lower side of sort of like expectations. But then again, it's what can Alibaba do about sort of deteriorating like macro conditions? It's not really, you can't really ask the management like why. It's not the management's fault there. But in terms of cloud computing, it's actually 10% of the business now, and that's growing at it grew 33% year over year. It's nice to see. My thesis around Alibaba as an investment kind of revolved around this cloud computing aspect of the business, becoming profitable. Well, it is a profitable, but becoming a bit of a profit machine, growing rapidly over time. Digital media and entertainment, this is mainly focused around sort of the streaming service. This didn't grow year over year. And then innovation initiatives, it's only 1% of revenue, and it grew well, 37% year over year. So carrying on, we can see cost of revenues increased quite substantially. So cost of revenue in the 3 months ended this year, it was 63%. So that it's quite. So it's a fair like increase, and that's gonna hurt their gross margins. So Alibaba will likely experience margin compression over the following years. You can see expenses across the board have increased. Product development expenses have increased. We can see marketing and sales have increased. General admin expenses, those have also sort of modestly increased, I'd say. In terms of marketing and sales, if you're spending money on marketing, as long as that money you spend into marketing ends up driving growth in your business, in my opinion, that's money well spent, as long as you're getting more than a double-digit return on any capital that you put into it. So as a general rule, we're just going to monitor the return on invested capital over time, and it should be okay. Investment in key strategic areas. So pretty much Alibaba, they're looking to get into some international sort of markets. Some of the fastest growing markets that they're getting into is Malaysia, Thailand, and Vietnam. They're really attacking those sort of areas with their Lazada e-commerce platform that they got going, but also with their Taobao deals, which is pretty much their answer to Pinduoduo. And within the conference call, they were discussing how they got 240 million AACs for that already, which is pretty damn impressive over such a short period of time. So we can see by this chart here that international commerce is becoming a greater percentage of the revenue over time, even though it's still really small compared to the China commerce. But we can see, Trendyol and Lazada, they're growing, 80 plus percent year over year. And then we can see, Taobao deals with their 240 million annual active customers. And then Alimi, I'm probably butchering that name, but they're growing. They're pretty much a food delivery service, and they're growing orders 30% year over year, which is strong growth. These growth numbers, while sort of less than sort of expectations, you can't it's hard to be mad at 30% plus growth. Cloud revenue continued to grow. It's up 33% compared to Q2 last year, which is pretty impressive considering recently they lost a major customer. I forgot the customer was the company behind TikTok. TikTok sort of international. It got bought out by Oracle, I believe. I might be wrong on that one, but that they took a major hit to the cloud revenue when they lost that key customer, but it seems like they're recovering from that fine, and growth is sort of continuing on that same sort of trend of around 30% year over year growth. The digital media and entertainment business, it's quite a slow growing part of the business, and it's fairly insignificant in terms of the total revenue it delivers. But I suppose they're like UQ platform. It did grow 14% subscribers year over year. It's nothing that crazy, and then again it doesn't really matter in the first place. Over now to the income statement. You'll notice I've highlighted some key sort of areas on the statement here. The first key area is the interest and investment income. So because of the new accounting principles, they have to include interest in investment income on these statements, which is kind of ridiculous. So you end up getting a skewed income number. But regardless, because their investments did really well in 2020, you can see that they had a 10,510 million RMB increase to their overall income, whereas they took a loss this year. So that's why it looks like they lost. That's why their net income looks like it's decreased so much. And then they've also had an increased tax expense, which is also taken a hit, which is triple the amount of their income tax expense from 2020. So that's why the net income has fallen from 26 bill down to 3 bill. So the company has 68 billion US dollars on the balance sheet. This is slightly down, from last quarter because of a buyback that the company did. They did a buyback of $5.1 billion. So, I'm pretty happy to see Alibaba, starting to buy back some of their shares, especially given, the depressed stock price right now. In general, if I believe the stock's undervalued, this is what I want to see. I want to see some aggressive share buybacks by the company, given that, they're not putting their balance sheet at any sort of risk. But honestly, Alibaba has an excellent balance sheet, and this is, a good use of capital in my opinion. In terms of free cash flow, we can see on the chart here, it is down quite significantly. It's pretty much down 50% from last year. This is reflected in higher capital expenditures. And the last thing I want to discuss, it's not actually on this presentation here, but it was regarding guidance for the rest of the year for the following 2 quarters. They're warning us about slowdown in growth due to economic conditions in China right now, and also increased competition. They're expecting annual revenue growth of between 20 to 23%. If I remember correctly, for the year. So, these next 2 quarters, they're expecting a pretty substantial slowdown. But guys, honestly, my man, it's hot in my room. But honestly, these earnings, that was, I guess, slightly disappointing. But my long-term thesis on the business remains the same. They're still growing at a solid rate, especially compared to what they're trading at currently. The balance sheet is really strong. They're investing back into their own business. They're buying back shares. In terms of the risks around the business, maybe I can do another video on that. But overall, I can't be mad at these earnings. I'm not that happy about them, but I'm not necessarily mad about them. I'm just going to hold for now and just let things, progress with the business. Anyway, guys, thanks for watching. Make sure you like, make sure you subscribe, and catch you in the next one.